The shock started quietly, almost unnoticed. Traders glanced at bond yields, shrugged at stock dips, and then it hit. A force that would ripple across the globe had begun to move. Japan, the world's largest creditor, was changing direction. Capital that had fueled markets for decades was being pulled back home, silently, steadily, inexorably. Every number, every yield, every market tremor told the same story. And the question on every investor's mind was the same. What happens when the lifeline that held the global economy together vanishes? The answer is closer than anyone realizes. Welcome to Boring Currency Index. If you've been following the market seriously, you know we don't sugarcoat anything. Subscribe to the channel right now, especially if you're watching from somewhere you've never traded before, maybe a quiet office in London or a small town in Texas. We track the real forces that move money, and now those forces are shifting fast. For weeks, silver has dominated headlines, but something far larger quietly broke in the bond market. Japanese government bond yields surged to levels unseen in decades. 10-year at 2.34%, 20-year at 3.47%, 30-year at 3.90%, and the 40-year surpassing 4% to 4.23%. For decades, Japan's economy survived on near zero rates. These new yields are not just numbers, they are a financial heart attack. The cost of servicing debt has multiplied overnight. Why does it matter to anyone outside Japan? Because Japan is the world's creditor. Trillions of dollars in US debt, hundreds of billions in global equities, all financed by capital chasing returns. Now, those returns are available at home. Money will flow back. This is not theory. It is the great repatriation, and it will pull liquidity from every corner of the globe. Hedge funds, banks, and investors who borrowed yen at near zero rates to buy tech stocks, crypto, and real estate, the famous carry trade, now face a trap. The yen strengthens, borrowing costs rise, and positions must be unwound. To repay loans, assets must be sold. Nvidia, Bitcoin, US tech, nothing is safe. The spike in Japanese yields is the pin that could pop the everything bubble. The tremors are already visible. Volatility in US markets, subtle but persistent, signals the early stages of the unwind. Analysts warn this is a sovereign debt crisis in slow motion, unfolding in the third largest economy on Earth. With a debt-to-GDP ratio near 260%, Japan cannot withstand this rise in rates without dramatic consequences. The math is ruthless, and the global system is about to feel the impact. The world did not notice at first. And while headlines focused on tech stocks, crypto, and silver, Japan quietly began pulling its money back. For decades, Japanese investors had been the largest foreign buyers of US Treasuries, European bonds, and global equities. Their capital flowed out steadily, chasing returns that were impossible at home. But the rules had changed. With domestic yields rising above 4%, the incentive to keep money abroad disappeared. Suddenly, foreign assets looked less attractive. Japanese banks, pension funds, and insurance companies began the slow process of repatriating hundreds of billions of dollars. It was not speculation, it was mathematics. Bond prices fell, yields spiked, and institutions faced gaps in their balance sheets. To fill these gaps, they had to sell profitable foreign assets, stocks, bonds, even alternative investments. Every day, capital returned to Japan, and the ripple across global markets grew stronger. Analysts called it the Great Repatriation. It was the sound of liquidity leaving the world. Money that had propped up markets for decades, US equities, European debt, corporate bonds, was being withdrawn. Investors in New York, London, and Hong Kong felt the pressure in subtle ways at first. Small dips in stock prices, tightening spreads, unusual volatility. For ordinary investors, it looked like market noise. For those watching closely, it was the beginning of a structural unwind. The capital that had flowed freely for decades was no longer available. The global system, built on cheap money from Japan, was suddenly being drained. This reversal was slow, deliberate, and unstoppable. Japanese institutions could not choose to stop. Rising domestic yields and collapsing bond prices forced action. Every sale, every repatriation was mechanical, a reaction to math, not emotion. And as capital returned home, other markets felt the pressure. Tech stocks that had relied on international buyers began to stall. Corporate bonds lost their backstop. Even crypto, a speculative frontier, showed cracks. The world was entering a phase it had never experienced, a slow, structural withdrawal of liquidity from the global system, and it was only the beginning. The Great Repatriation had started in Tokyo, and every market that depended on Japanese money was about to face the consequences. It started quietly, almost invisibly. Traders in New York noticed slight pressure on tech stocks. Hedge funds in London felt the cost of borrowing rising. But in Tokyo, the shock was absolute. The spike in Japanese bond yields was no longer just a number. It was a trigger. For decades, the global system had relied on a single dynamic: cheap money from Japan. Hedge funds borrowed yen at near zero rates and converted it into dollars to buy US stocks, crypto, and real estate. This was the famous carry trade, and it fueled one of the largest leverage machines in history. Now, the math had flipped. The cost of borrowing in yen exploded. Those loans could no longer be rolled over cheaply. Margin calls rippled through the system. Traders had no choice. They had to sell the assets they had bought with borrowed money. Nvidia, Apple, Bitcoin, commercial real estate, they all faced pressure at the same time. This was not panic. This was forced selling. Structured, relentless, and predictable. Every sale triggered more selling. Every dollar repatriated to Japan removed liquidity from the global markets. The dominoes were falling one by one. First, the yen strengthened, making carry trades expensive. Then, U.S. equities saw subtle declines. Tech stocks, which had long been the global ATM, started to wobble. Hedge funds, forced to close positions, added to the downward pressure. Bonds, thought safe, were no longer immune. U.S. Treasury yields edged higher. Corporate bonds widened. The ripple became a wave. Analysts warned this was a slow grind, not a flash crash. There would be small recoveries, brief rallies, but the structural pressure remained. The selling was involuntary, driven by math, balance sheets, and domestic survival. The world had never experienced this kind of event. A creditor that had always supported the system was now extracting capital, not deploying it. And every market that had depended on Japanese money, stocks, bonds, crypto, even money market funds, was now vulnerable. The slow, relentless grind had begun. Japan was not just adjusting its own economy, it was rewriting the rules of global finance. And as the first domino fell, the next one was already teetering, waiting for the inevitable nudge. The world now faced a stark reality. The Japanese switch had been pulled. The repatriation of capital was no longer a future risk. It was underway. Stocks, bonds, and other paper assets were caught in a slow grind downward day after day. Every rally was fleeting, every dip deceptive. In Washington, alarm bells rang quietly at first. Japan, the world's largest foreign holder of U.S. debt, was stepping back. If Japan stopped buying, or worse, began selling, treasuries, U.S. interest rates would spike. Mortgages, auto loans, corporate debt, all would feel the strain. The economy could seize, not in a single dramatic crash, but in a grinding collapse over months. The Federal Reserve had no choice. To prevent a complete blowout of the bond market, it would be forced to step in, printing trillions to absorb the supply Japan was offloading. This was not theory, it was a mathematical necessity. The act of saving the bond market would weaken the dollar, and every printed dollar would reduce purchasing power worldwide. Amid the chaos, some investors understood the real story. Wealth was not destroyed, it was transferred. Paper assets lost value, while physical assets gained. Gold, silver, and other commodities became the safe harbor. In a system unraveling from the top down, hard assets were sovereign. They could not be called in, debased, or erased. The Japanese crisis had ignited a wave that would touch every market. Stocks could fall slowly, bonds could lose their hedge, crypto could crash in phases, but metals and tangible resources would rise. The slow grind of the paper markets was mirrored by a silent melt-up in commodities. For those paying attention, strategy became clear. Step away from over-leveraged, fragile assets. Focus on tangible wealth, precious metals, energy, and farmland. Understand that the unwind would take 12 to 24 months, and volatility would be constant. Patience was critical. Rushing into panic could trap even experienced investors. The lesson was unmistakable. The era of cheap money, zero interest rates, and reliance on foreign capital had ended. Japan had pulled the switch. The global system was rewiring, and the choice was stark: cling to the burning paper world or move to the physical lifeboat before the tide fully receded. In the end, survival would not depend on luck. It would depend on understanding the mechanics, recognizing the slow grind, and positioning wisely. Japan had sounded the alarm. The question for the rest of the world was simple. Would they act or watch as the transfer of wealth unfolded before their eyes?